Hello. Listen, folks, I think I found another high probability trade. This is the OIH. This is a profit chart of the OIH, the Oil Services Industries ETF. And as you can see, this is a 3-year chart, but I've zoomed in on it. Each candle represents a week. And if you take a look, here's this is this week so far. Today is January 24th, 2007, Wednesday, and it looks like the close today was about 135.95 on that particular ETF. Anyway, if you take a look, I've identified a couple. Here's what I consider a support area that I want to design a trade around, and then here's a resistance area. So as you can see, we're right here about in the middle of those two lines that I've identified. If we jump over here to the chart, here's the trade that I'm suggesting that I might go into as soon as tomorrow. It's an iron condor, and it's, in my opinion, high probability winning trade. The risk-reward ratio is, let's see, assuming 10 contracts, my maximum profit is anywhere in between here, in between the short strikes, 120, 115, all the way up to 160. So I'm looking at the March contracts down here. If you see at the bottom of the screen, here's the trade basically. I'm going to create the iron condor, I'm going to sell 10 March 160 calls and buy 10 March 165 calls, creating the bear call spread for a credit. Then at the same time I will short or sell 10 March 115 puts and buy 10 March 110 puts, creating the bull put spread for another credit. My total credits will accumulate to 50 cents per share. Okay, so now what you can see is if you look down here in the bottom left hand corner, you'll see that my maximum loss is $4,500. The green line on March 17th. And then my maximum gain would be anywhere in between those short strikes of $500. So let's jump back to that chart a quick moment and see what you think about that. Again, if price ends up, here we are at towards the middle of January, approaching the end of January. And my cursor is pointing right now at March 19th, which would be expiration for March. So if price ends up right anywhere in between these blue lines, we collect the full $500. If it goes outside the blue lines, then we start getting we start minimizing the amount of profit, and possibly, depending on how far out of the blue lines it goes, there is a potential for loss. So here's that 115 price, and break even is just slightly underneath that. And on the top side, there's that 120 price, the 160 price. That's the maximum profit range. And once you start getting outside of that, then you start into that deep, steep slide into the potential loss zone. So again, I consider it, if you take a look here, I've got it set up for probability of touching by, let's see, February. Let's move this up to March 17th. 3/17/07. Okay. Probability of touching that price by somewhere between now and March 17th is 13.5%. Probability of touching on this bottom side down here is 10.78%. Okay, let's go switch to probability of expiring. Probability of expiring outside of the break-even point on the top side is 6.75%, and probability of expiring below the bottom side break-even is 5.38%. So again, I say that I'm suggesting that this is a high probability of win, and the risk reward is $500 of potential maximum profit. Maximum loss is $4,500. If I punch that in the calculator quickly, the rate of return over investment is about 11.1%. Okay, so any questions? Just shoot me an email, and I will see if I can't answer any questions that you have concerning this trade, or any other questions that you might have. I'll give a shot at answering. I am currently taking requests for videos. If there is a subject that you would like to learn more about related to options or technical analysis, please shoot me an email, and I will see what I can do to accommodate your request. Thank you for viewing my video, and good luck in your trading.